Hello everyone, my name is David Wilbur. Today I'll be just talking about Valeant Pharmaceuticals and providing a bit of a comprehensive analysis regarding Valeant's history, its current financial position, some of its past successes and failures, and a few other details to help provide a good understanding of where this company is at both domestically and internationally. And so getting right into it, the history of Valiant, it was founded in California in 1959 by a man named Milan Panique, who ran the company for 47 years under the name ICN, which stood for International Chemical and Nuclear Corporation. In 1994, they merged with SPI Pharmaceuticals, and later in 2003, after Panique's resignation, they changed their name to Valiant, obviously its current name. And most importantly, in 2010, they merged with a company named BioVale, retaining the Valiant name, but reincorporating itself in Canada, where they're currently incorporated in Laval, Quebec, and naming Michael Pearson the CEO, which was arguably the worst decision the company has ever made. And they set out on a path of aggressive acquisitions, which Pearson attempted to use to transform Valiant from a platform company into this global powerhouse in the form of massive acquisition and taking on massive amounts of debt. So what ended up happening after the company's stock almost bottomed out from massive amounts of debts and from uh, public pressure regarding drug price hikes and questionable at best policies for insider trading and the manner in which they operated, they appointed a new CEO in Joseph Papa, who was given the task of turning the entire company around. And they've set out on a new path geared towards strategic sales, debt reduction, organic growth, which Mr. Papa believes will effectively turn the company around, although he emphasizes that it is not a one-day process and that they'll need to do it a little bit at a time. So what Valeant does briefly is that they develop, manufacture, and market a range of pharmaceutical, medical device, and over-the-counter products in the areas of eye health, gastroenterology, and dermatology, which they refer to as orthodermatologics. I've also included that they were ranked 28th among the top 50 global pharmaceutical companies in 2017. And I didn't incorporate that to try to push the fact that they are a successful company, but I did so to try to emphasize the fact that amidst all of these issues, they're attempting to turn themselves around and attempting to get back on track, which I think is a very important thing to note throughout the majority of this presentation. And so, in order to compete in the pharmaceutical industry and with companies such as these, as well as many other companies, because the pharmaceutical industry is a vast one and a very competitive one, and one that's anything but static. And so, it requires constant adaptation in order to at least attempt to establish any type of value for both the shareholders and for consumers. And so, what Valeant has done and what they've identified in the 2017 annual report is they're attempting to completely transform the company with a series of multi-year plan and with a three-step process that they believe will help turn the entire company around and get away from the acquisition mindset that they had before and taking on, as I said, massive amounts of debts that wasn't providing value to shareholders and wasn't providing value to consumers. And so what they're doing is they're investing in core franchises with attractive growth. And they've identified three competitive positions in attractive markets such as eye health through their Bush and Lomb segment, gastroenterology, and dermatology, which they refer to as orthodermatologics. And so they believe that each of those markets affords them opportunities for growth and represents a therapeutic area where their experience and expertise can provide value for their company and for their consumers. And the next segment is the launching of new products that create those meaningful opportunities. And in terms of that, they have 71 projects currently in their R&D pipeline that are focused on those three core businesses, and they anticipate submitting more than 60% of those projects for FDA approval in 2018 and 2019, as well as the fact that they anticipate increasing their R&D spending by more than 15% in 2018 as compared to 2019, although in 2018 their R&D expense as a percentage of their revenue is anticipated to exceed 4%, which is much higher than it was in 2016 and in 2017. And so the final part of this three-step phase is to resolve legacy issues and de-risk their balance sheet. And on their annual report, their CEO, Joseph Papa, pointed out that their legal team had succeeded in achieving dismissals of or settlements of more than 80 litigations and investigations. And I think it's important to note that not only is 80 litigations and investigations an extreme task for any company to deal with, regardless of size, I think it really paints a picture of the position that this company was in and the danger it was in, really, of becoming insolvent. And so what they did by settling those litigations and by unloading some of that debt is they lowered their total debt since the first quarter of 2016 by almost $7 billion, which has helped significantly to alter the direction of the company. Although they also pointed out that no dividends were declared or paid in the previous 3 years, nor do they intend to pay any cash dividends in what they deem the foreseeable future, which I think is also indicative of the struggle that I mentioned before, that they're trying not only to stay afloat, but also to try to claw their way back into the industry. Moving on to their top and senior management, and I'll only discuss this briefly. As I've mentioned, Joseph Papa is arguably the most important player in the game of Valeant's turnaround of their company, as well as his assistants from Paul Herendeen, who also plays a major role. And they were both brought on in 2016 to replace Michael Pearson and replace his subordinates and try to turn the entire company around. Although every member that I have listed here, Christina Ackerman, Thomas Apio, Dr. Lewis Yu, Barbara Purcell, Dr. Taj Ramakrishna, and William Humphreys, who is their new executive VP of orthodermatologics, a very important position in the company, and I'll mention why a little later on. But overall, the top management was all brought in to try to clean house and completely restructure the entire company and put them on a path towards success instead of the descent that they were experiencing at the time. All right, so getting into a little bit of the finance aspect of the company's position currently, I've included a few analyst recommendations, and I think it's the most important thing to note here is, for one thing, the current price target of the stock, and the stock closed yesterday at about $15.77 approximately, and their price target at $17.50 is about a tenth of what they hope it would have been at this time. So when they brought Joseph Papa on, they gave him a compensation plan that was structured around the fact that if the stock price was able to meet $150, he would be rewarded with a $500 million compensation package in the way of common shares in excess of 1.8 million shares. And so what ended up happening instead is the stock has not grown nearly as much as they anticipated. And so each of these analysts recommend a very similar thing. And what the feeling is basically is that while Valeant has made progress in stabilizing its core operations and addressing near-term debt maturities, they overall still face a very significant issue in terms of leverage and in terms of equity. And so what these analysts believe is that it's a less than favorable risk-reward situation, meaning what you're getting out obviously isn't worth what you're putting in. And so basically they believe that the core franchise of Valeant remains a work in progress, although, as I pointed out before, there are bright spots in way of restructure and segments such as their Bush and Lomb, and the fact that Bush and Lomb was actually granted access into a very important European market. And so it's putting them in a position where their stock is potentially on the way up, but they're not quite out of the woods. So as you can see here, 4 out of these 5 analysts all recommended a hold position, meaning you don't necessarily need to sell the stock, but it's definitely not um, enticing to buy it just yet. And here I've just incorporated a quick stock price comparison graph just to kind of show, as is represented by the blue line, the volatility of Valeant's stock price from the middle of 2015 to the end of 2017, having dropped almost from $250 down to at its lowest $5 and its current price of $15.75, which I think accentuates the notion that I was trying to stress before, in that the drug price hikes and all of the scrutiny regarding insider trading really completely tanked this entire company, and they're really struggling to try to turn it around. Although, as I mentioned before, that is more of the inclination now, is that it is on the upward trend as opposed to a downward trend, although they haven't really succeeded at witnessing any legitimate growth. Moving on to that insider trading, I'll very briefly discuss what happened. A hedge fund investor named Bill Ackman attempted to persuade Allergan to sell itself to Valeant because he had invested billions of dollars in one of Allergan's products. And so what ended up happening was Allergan didn't want to sell itself to Valeant, ended up selling itself to another company, and it cost Ackman billions of dollars, and they were immediately investigated by the SEC, and ended up having to pay out millions of dollars to Allergan to settle the dispute, which wasn't one of the more massive debt instances that occurred for the company, but it hurt its public image immensely and was a major reason for the plummet of its stock. Getting into some of the current news, though, and I won't mention all three, but I will briefly discuss the third one, which was an article written by Smarter Analyst that discussed the announcement of a new drug in the division of orthodermatologics for Valeant, which was the very first time positive results have been published assessing a safe and effective lotion in the treatment of plaque psoriasis. And the VP of the orthodermatologics division, Bill Humphries, asserts that this is a major milestone for the company and a major advancement, and is right in line with the creating good opportunities and investing in areas that work with their core strengths, which they believe will help turn the company around altogether. And so here I have a table of financial data. And so what we're looking at here is Valeant, Teva, and Abbott, and Allergan in comparison of their P/E ratio, dividend yield, bond ratings, and beta. And I think the biggest thing to note in this table is the numbers in Valeant section. First being P/E ratio, which we know is an indication of how much an investor is willing to pay for $1 of earnings. Valeant's is considerably lower than the rest at 2.31. And as well as their dividend yield, which, as I mentioned before, they have not paid out dividends in the last 3 years and don't expect to. Similarly, their bond ratings are the lowest of all 4 of these companies. And so I've incorporated here 2 more graphs, return on equity and capital structure. And I think the biggest thing to note here in regards to return on equity, which, as we know, is indicative of how well a company can use investable funds in order to generate growth. It's just another metric that Valeant has struggled with since July of 2015 to the end of quarter 4 2016. But what you do see is that it is on an upward trend. They have managed to turn their company around at least enough to start generating more sustainable growth and to start driving revenues in a more profitable direction, in a direction that's more profitable for shareholders. But what you also see in regards to their capital structure, within the manner in which their debt to equity is set up, is their total debt to total equity is 435%. And that just accentuates why investors are so hesitant to get on board with this stock, because regardless of their ability to unload some of their debt and to invest in these areas that correlate with their core competencies, that's still a metric that they need to work on, and they still have a significant amount of progress to make before they can attempt to generate any type of investor excitement. Um, and again, that's here by the book value per share growth, um, which also is interesting because if you look at 2017, 2018 for Valeant, you see that their book value per share is listed at about 16.97, and as I mentioned before, their current stock price is around 15.77, which means that their stock price in relation to book value, their stock is currently undervalued by almost $1, which does imply that there is room for growth and there is potentially reason to get on board with Valeant stock. Although again, there still is progress to be made in terms of the company's overall direction. Here I just have listed some mergers and acquisitions. As I said, Valeant has been a staple of acquisitions, beginning as a platform company and just buying for almost 7 years under the direction of Michael Pearson, and it led them to almost their inevitable demise. And then finally, my final topic, which is one of the most important ones for any multinational company, particularly in the pharmaceutical industry, which is their management of foreign exchange rate risk. Um, and so, due to the large portion of business that they conduct in currency other than the US and outside of the US, the risk associated with this international operation and the scope of international operations, as well as their presence in emerging markets and the challenges they face trying to enter and operate in these new geographic regions, any of these adverse global economic conditions and foreign currency uncertainty and volatility can cause a significant strain on the company. And so what they do is they, as was pointed out in their annual report, is they try to attempt to manage foreign currency risk by managing same currency revenue in relation to same currency expenses to try to do their best to alleviate some of those risks and affirm that to the shareholders. And so that brings us to, should we buy Valeant stock? And personally, after consideration of all the information I've studied, I think no. As in consistency with what the other analysts said, um, currently Valeant is not in a position where they are generating legitimate profitability or any type of sustainable growth. They're in a transformation phase. And so it's not necessarily a sell phase, but it is a hold phase, and it's not too enticing at this particular time to buy. Although again, they are on an upward trend, and they are a company that could, at some point, be definitely enticing for a lot of investors.